Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing pretty good. How about yourself?
Good, thank you. Today, Ty, we're going to talk about October market volatility. Unfortunately, it's an uncomfortable situation that a lot of investors have gone through most recently here in October. We saw some significant drops in all of the indexes out there. We saw certain indexes that had done very well last year in 2017 or the beginning of 2018 due to tax reform now start to suffer. So we're going to talk about some of the reasons for this October market volatility. And we're going to talk about some of the excuses that you're also hearing online and on TV and on the radio, and we're going to try to debunk some of those. But first of all, just talking about an overview, again, most of the indexes that we're familiar with, the NASDAQ, the Dow, and the S&P all suffered a lot in October. And at the end of the month, last couple days of the month, as well as the first day of November, we saw a little bit of a pickup. Don't know if that's going to continue, but what we're going to do is look at economic indicators. We're going to look at political indicators. We're going to look at interest rates and try to give you an idea of why this volatility is happening. Also remember, too, if you are in your 20s, 30s, 40s, 50s, if you're 10 years or so away from retirement, having some of this volatility bringing the market down is actually, in a way, good for your portfolio if you continue to contribute to it. If you're not contributing, you're just going to go with the wave. But if you are contributing to your portfolio, you're able to buy more shares at a cheaper price. So when the market does recover, it's better for your portfolio. So always look at the half full situation instead of half empty glass situation. Tyler, what else can we talk about in an overview of what we saw in October?
Yeah, Dean. So with that said, we saw a market correction earlier this year in February. And again, a market correction is defined where there's a 10% or a 10% drop off a recent high point. If it goes down to 20%, then the term is a bear market. We haven't seen that yet. But earlier this year, back in February, we saw a market correction where the market got volatile. So a market correction, it went down again due to different tariffs and sanctions, a trade war, higher interest rates, higher inflation potential. That's what kind of spooked the market earlier in February. And now the market volatility has returned again in October. And with that said, I just want to give a couple numbers here that will kind of indicate how the month of October did. And first off, the NASDAQ. So the NASDAQ is a stock index comprised of a lot of tech and tech healthcare companies. So the tech-heavy NASDAQ fell 9% in October, which was the largest monthly drop in about a decade. So the NASDAQ fell 9%. The S&P 500 lost nearly 7% in October, and the Dow lost 5% in October. So again, those numbers right there, the market, the NASDAQ, S&P, and Dow dropping 9, 7, and 5%. Again, in 1 month time, that's a lot of volatility. Those are steep sell-offs there. And in addition to that, the developed international stock markets lost about 9% in October as well. So not only here in the U.S. are we feeling it, but it's all throughout the world. The month of October took a dive, hence the international stocks down 9% as well in October. And with that said, the recent October losses, it wiped out a lot of the gains for the year, although we still are all positive in the S&P and Dow, which hover around a 1.5% gain year to date. So from the beginning of the year through the end of October, The S&P 500 and the Dow Jones are up about 1.5%, whereas the NASDAQ is still up about 6% year to date through that time period as well. So we still do have gains, more so on the NASDAQ because the tech sector really took off earlier this year. And here's a term that we've been using a lot lately, but the tech sector, they're leading the battle. And if you're the ones that lead the troops into battle, you're going to meet the enemy first. And that's kind of what we've been seeing with the different tech sector, where we saw sell-off in Facebook, Amazon, Twitter. A lot of the large tech companies that have done really well were kind of the first to hit the enemy, meaning the first to hit the volatility and head downward. But in general, when we talk about the current October market volatility, it's been caused by things such as the potential for slowing growth rates, trade wars, midterm elections coming up here in early and mid-November, as well as the potential talk of higher interest rates. So that's just kind of a brief overview of where we're at now with the October market volatility. We're going to get into the potential factors as well as what to do with your portfolio, if you're worried about the volatility.
Okay, some economists said that the economic growth in the United States and around the world has actually peaked, and they believe that that is part of the reason for the volatility. We don't tend to necessarily believe that 100%. And part of the reason is if you look at a number of the indicators out there, and go to a source that is not putting a lot of politics behind the numbers, just the pure numbers, economic numbers. Go to Morningstar, look at some of that information. Investor.com, Fidelity, Vanguard, TD Ameritrade also have some that don't skew one way or the other when it comes to political affiliation. And really what's happening here is the economy is very strong right now. A lot of indicators out there show that it's going to continue for some time. Of course, there are some bumps in the road, one being tariffs. But if you look at economic indicators, inflation still hasn't raised its ugly head at this particular point, though we do anticipate we will start to see some of that in 2019, maybe 2020. So we'll have to address things like that in portfolios as we go further along into next year. But unemployment rate is very low. Tax reform has helped those companies add additional employees. As a matter of fact, it's very hard for a lot of companies to hire enough people to fill certain positions. So what's happening is we're seeing more jobs available than there are workers, or at least quality workers for that particular job. The GDP has increased. So that has been very helpful. The housing market is very strong. Our financial institutions, whether it was through regulation or deregulation, remain strong. And there are a number of those barriers still in place to offset some of the subprime mortgages in the collapse that we saw in 2008. So all of these indicators are looking really good. And consumer confidence is at an all-time high. So when you look at those things, has the economy peaked? Is that the reason for the volatility? We don't necessarily think so. However, when you look at somebody's personality, when they start looking at the market and their own psychology, they think that the market has been going too good for too long, and they're just waiting for the sky to fall is basically it. So we're seeing some of that. Tyler, what else when we talk about economic factors and the volatility? Am I missing something here?
Yeah. So when we talk about economic growth potentially peaking, I know that's one of the potential concerns for volatility. That's what's causing some investors and institutions to sell off, where they think that right now, and they use the term peak, where they think that the market is peaking, meaning they think stocks are too overvalued. So what they're doing is they're selling off. They were selling off stocks at the end of September into and out throughout October, taking a lot of the gains off the table that they've had from the last couple years because they think they're too overvalued. So they're selling off, taking profits off the table, as we call it, and building up cash, waiting to buy in should something happen after the midterms or into 2019 or 2020. So right now they think stocks might be too overvalued and economic growth has peaked. However, This could all simply be a healthy market correction after the market run-up we've had over the last 9.5 years now, because keep in mind, since the market bottomed out in early 2009, that was after the Great Recession, when the housing market collapsed, led to the various big banks to fail. That was back in early 2009 when it bottomed out. And since then, we haven't seen any type of bear market. We have seen a couple pullbacks and corrections, but these could be more and more common now, especially because we haven't seen, again, a bear market is a 20% decline off the recent high point. We haven't seen that since going on 10 years now, which is the longest bull market that we've had. And again, a bull market is years that we've had without a correction or without a bear market. So this could simply be a healthy correction, and people are overreacting, thinking that economic growth has peaked. And in addition to that, this last week, the new consumer confidence figures were released, showing optimism at an 18-year high. So again, it's at an 18-year high. It was never this high since going back to 2000. So again, that's a good sign for economic growth from a consumer standpoint. But ultimately, what a lot of people doing are simply looking for a reason to sell. They're thinking that stocks are too overvalued, selling them off, taking profits off the table, and building up cash, anticipating something to potentially happen during the midterm elections. And then in addition to that, looking into 2019 and 2020, and then they'll use that cash for a buying opportunity. But we don't necessarily think that economic growth has peaked because, Dean, as you touched on, again, the economy is still the underlying economy is still looking strong. Companies' earnings continue to beat their estimates, and unemployment right now is at an all-time low as well. So the underlying economy does look good. We still think there's room for growth, but the potential speculation of economic growth peaking is what is leading to some of the current market volatility and some of the current sell-off that we've seen in the month of October.
Okay, the next thing we're going to talk about is midterm elections, which Tyler and I tend to believe that this is a major reason for some of the volatility in the market. Not the only reason, but a major reason. And part of the reason is you look at the last presidency, we had a Democrat in place for 2 terms. You look at our current administration, you have a Republican president in place into his second year. And what has happened in the last couple of years is you have the Trump presidency come into play. We've seen significantly lower tax rates in business deregulation. So it's very pro-business. So what has happened is you're seeing, record profits from a lot of these companies, which when they come out, of course, shareholders are very happy with, because the stock price typically goes up when you have a very favorable report on sales and profit. So your current administration is very pro lowering taxes, pro business deregulation. People are worried right now with the midterm elections coming up, which is getting a tremendous amount of play out there, because if the Democrats do come in and take over the House or the Senate, that could lead to a less friendly business environment. Hence, stock prices would be affected, because typically the Democrats are more pro-taxes and more pro-regulation instead of deregulation. So there's that uncertainty from a political standpoint that is creating some volatility in the market. Whether it'll all play out or there's more volatility than there really needs to be is yet to be seen. But midterm elections are having a play on it. Tyler, what else about the midterm elections and the volatility?
Yeah, Dean. So again, like you mentioned, another reason for the current October market volatility is midterm elections. And with that said, the midterm elections spook the stock market in October leading into November, because obviously that's when the midterms happen. And really, when you think about it, so many things in today's world are so politically driven that it makes sense for investors to be on edge, so to speak, with what happens in the midterm elections. And President Trump, as he often does, he even tweeted this last Tuesday that the stock market is up massively since the election, but it is taking a little pause right now to see what happens with the midterm election. So a lot of people are, having their voices heard and influencing what happens with the market in terms of the midterm elections. Now, there's a couple things with that said. Historically, the controlling party of the White House, which right now is the Republicans, historically, the controlling party has lost seats in both the House and the Senate after midterm elections. So that means we'll have to see how that bodes for President Trump potentially facing Democratic control of Capitol Hill. Should that happen, and the sides flip and kind of the tides turn, that's a whole different ballgame then with Trump potentially facing Democratic control. And the other thing too, Dean, which is what you touched on a little bit, right now the Trump presidency has seen lower tax rates, obviously with the tax reform law going into effect, as well as business deregulation. Both of those things have positively affected the economy and the stock market so far. Obviously, when you cut individual tax rates as well as corporate tax rates, a lot of those profits are going to go back into being reinvested back into the business. More of that tax dollars are going to go into consumers' hands as opposed to the government, therefore stimulating the economy. So those are two main things right now that have helped the market that the Trump presidency can take credit for. But right now, with that said, a lot of the stock market, they have fears they could be lingering with the Democrats flipping the House and or Senate because, as you said, Dean, typically Democrats are going to be less friendly to business and more open to regulation and higher taxes, whereas right now we just saw the tax reform law and, again, a lot of the deregulation still taking place and still having a positive effect on the market. So right now, again, the main thing with midterm elections is simply the uncertainty. And obviously the stock market doesn't like uncertainty. Whenever there's any type of anticipation or uncertainty leading up to a major event like a midterm election, people and institutions are going to be more apt to sell off, sit on the sidelines in cash and kind of wait things out and see what happens before going back in. So again, with October, that's what happens where a lot of the larger institutions and investors, they sold off and took money and kept it in cash, and they're simply waiting to see what happens with the midterms before they go back in again.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, now we're going to talk about trade war with China and how that is affecting the market with the volatility. The United States has made significant headway with trade agreements with Mexico and with Canada, and in principle with the European Union, even though it hasn't been executed yet, with Japan, with South Korea. So they're making headway there. However, the United States is the largest economy in the world. The second largest economy in the world is China, and everything else is significantly below those two. And if you look at it and see that we have a trade war going with China, in a way, I think we might have underestimated the Chinese resolve because it seems to be we take one step forward and two steps back with the talks. And the worst case scenario with a trade war with China is it would become prolonged and actually get to a point where the Chinese decide to wait until a new president comes in play, hoping that they will not have to buckle underneath some of the trade that they believe is not in their best interest. So right now, the trade war with China is taking a significant toll on investors' confidence right now in the market. We have seen over the last couple of months when it comes to earnings reports and listening to what the CEOs or CFOs of these particular very large Fortune 500 companies are saying, we're hearing more and more and more conversation where they're telling us their numbers are off because of trade restrictions or tariffs they're now starting to see. So it is starting to give a lot of businesses in the United States a bit of a bloody nose. That is not to say that it is not the right thing to do. Getting, trade disputes put in place, getting tariffs on an equal playing field is a good thing for the United States. It's a fair thing. But unfortunately, during this process, it's created a lot of market volatility. And unfortunately, it's also created some misses when it comes to earnings report with these large companies. Tyler, what else about the trade war with China are we seeing that's creating volatility?
Yeah, so with the trade war with China, when it comes to market volatility, the trade war with China, that's been the main factor, not only in terms of October, but throughout the whole entire year, really. Because if we go back and look earlier this year into February and March, you had the tariffs and sanctions, and now and then the trade war with China. This really started months back, but it really continues to linger and potentially even flare up now that the midterm elections are coming up. That's a lot of things that's one of the main things that a lot of Democrats are bringing up, is a potential trade war with China and how that affects the U.S. economy. So again, the trade war with China, that's been a main one throughout the whole entire year, which could potentially cause, and it has been causing, the market volatility. But again, that continues to weigh not only on the stock markets here in the U.S., but internationally as well. As you mentioned, Dean, when you have two of the largest and strongest economies in the U.S. and China going at a potential full-fledged trade war, the end result typically isn't going to be too pretty. So again, stock market doesn't like trade tensions, because what happens is there's been tariffs imposed on U.S. goods and Chinese goods, which make it more costly for the U.S. companies to do business with China, and vice versa, because there's tariffs being imposed. So again, a tariff is like a type of tax that's imposed on goods that are going to or from China and or the U.S. So again, if companies are paying tariffs and sanctions and different tax on goods like that, that's going to eat into their bottom line. So that's where we see the trade war starting to affect various companies' revenue and profits. And this is another factor that might think economic growth is slowing down just due to the potential of a full-fledged trade war. And again, when the trade war starts to affect various companies' revenue and profits, that's going to affect their stock price, which leads to the stock market sell-off, kind of what we saw just recently here in October. And also, plenty of goods in both the U.S. and China have been subject to tariffs. But one potentially positive factor is that President Trump has recently said that a trade deal could be done right now, if need be. But the U.S. is waiting to get an even more fair, or a better deal, a more fair deal with China. So again, trade war with China, that's one of the main reasons for the current volatility that we've been seeing. But it was also a reason earlier this year, and it will continue to linger until that deal is done. Market volatility, we think, will continue to be here because, again, like we've seen earlier this year all the way through October, if there's any mention of a potential trade war with China, the market will go down. If there's any mention that a deal could be coming closer to a trade or to a trade deal with China, the market will go up. So again, it's a big cause for volatility, something that we have to keep our eye on throughout the midterm elections, the end of the year, and into early next year.
Okay, the next one we're going to talk about is interest rate increases. We are now in an environment that we haven't been in some time when it comes to interest rates. We're seeing a rising interest rate environment right now. Over the last administration, we had very, very low interest rates, which was an attempt to stimulate those people to go out and borrow money to help grow the economy. However, it really didn't happen. We had very low interest rates, but the economy wasn't growing. And unfortunately, interest rates, when they're low, also hurt those people who are trying to save. So what it did do is it forced some people, mainly retirees, to make a decision to go into, dividend-producing portfolios, equity portfolios, in lieu of bonds or treasuries, which at times might have put people into a risk that was more significant than they should have been taking. However, if we look at interest rate increases right now, we still are in a relatively low interest rate environment. So it's hard to believe that the significant portion of the volatility is created based on interest rate increases. I mean, my goodness, I think the 10-year Treasury is right around 3%. So, would people significantly sell off and go into treasuries in lieu of dividend-producing stocks? Well, if somebody starts that ball rolling and there's a sell-off, yes, they will. And we did see some of that happen. But again, we don't tend to believe that the interest rate increase is the major reason for the sell-off. We tend to think it's more of just uncertainty in the market, trade war with China, and so on. Tyler, what else about interest rates should we be talking about when it comes to volatility?
Yeah, Dean, just the main thing here with potential interest rate increases being a cause for volatility. Again, the market doesn't like it when interest rates go up. We don't think it's a huge factor, but what does happen when interest rates do go up? More people are likely to sell off and go into different bonds that are paying a higher rate. In addition to that, it can spook the stock market a little bit because when interest rates go up, the cost of borrowing for companies also goes up. So again, they're going to be spending more to borrow and different things like that. So again, it is a minor factor for the volatility in terms of interest rate increases, because with it, again, like I said, with it going up, companies are going to incur more costs and expenses, so they don't like that. Something to keep an eye on, and interest rates will continue to go up. We're in a low interest rate environment. They continue to go up. Nothing major, but again, the market doesn't like it whenever there's any term of interest rate or inflation increases.
Okay. And really another thing here, what should you be doing with your portfolio when there's volatility in the market? It depends at what stage of your life you're in. If you're retired, remember, no more money is coming into the portfolio, so you need to make sure that portfolio can take care of itself. And what we mean by that is, have an active risk-managed portfolio where you can build up cash at a time like this. So when the market starts to decline and finally, hits that trough on the bottom, you can then take some of that cash that was built up and moved into a money market account and then buy equity positions basically at a discount. They're on sale, and that'll help you get out of that trough quicker. Rebalancing your portfolio is also important. So throughout 2017, we saw a lot of portfolios come out of balance where equity positions got significantly higher than bond or cash positions. That's a good opportunity to take some of your gains off the table. Take them off the table. If something had gained, 30 or 40% in a portfolio, which some did in 2017, take that, give a haircut to that particular equity position and move that money, some of that money into cash. Not all of it has to be reinvested, rebalanced, but move some into cash. You want to build cash when the market is good so you can buy when the market is bad. So that is really a rule of thumb. Anything else, Tyler, when it comes to what people should look for volatility in their portfolio?
Yeah, Dean, good points here. Just that market volatility, it's a normal part of being invested in the stock market. For those of you who are younger, take advantage of market volatility. When the market's low, continue to buy in every single month. You're buying more shares at a low. So keep on keeping on when you're younger. When you're older, you want to be more proactive, and that's what we are with our clients. We really advocate actively risk-managed portfolios, and that comes with being proactive. If you're pre-retiree or retiree, you don't want to go with the ebbs and flows of the market. So right now, we're making some moves in client portfolios, building up a cash position, and again, the volatility could be here to stay. Continue to monitor the market and see what happens, through the end or with the midterm elections through the end of the year and into early next year.
Okay, folks, that's all the time we have this week. See you later and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.